Welcome to the SyncUp Business Services Data Security Training. Today, we're discussing the Gramm-Leach-Bliley Act, or GLBA. What is the GLBA? It's a federal law that requires companies that handle financial information to protect the confidentiality and security of their clients' data. It also mandates the development, implementation, and maintenance of a structured information security plan. You might think this only applies to big banks, but the GLBA applies to any business significantly engaged in financial activities, such as, but not limited to, check cashing services, mortgage lenders, tax preparation firms, accountants, and of course, bookkeepers. Since SyncUp Business Services is significantly engaged in financial activities, we are required to protect our clients' data against any anticipated threats or unauthorized access. So, what exactly is the information the GLBA is protecting? In a nutshell, it's protecting non-public personal information, or NPI. This includes any information a client gives a business to obtain a financial service, such as details about their income, social security number, account numbers, and/or account balances. It even includes the information related to the fact that an individual is our client. However, it doesn't include information lawfully made available to the general public, such as widely distributed phone books, real estate records, or publicly available government records. Let me break it down to make it more simple. The GLBA has two main parts we must follow. The first part of the GLBA is the privacy rule, which governs how we share NPI information. Under the privacy rule, businesses must provide a clear privacy notice to customers by the time the business relationship is established. Then, to stay in compliance, businesses must provide the privacy notice annually for as long as the client remains a customer. Once issued, the privacy notice is valid for 12 consecutive months. However, if there are any changes to the privacy notice during the course of the 12 consecutive month period, the business is required to send the updated privacy notice to all clients at the time the change is implemented. At SyncUp Business Services, our privacy notice is automatically sent electronically to every client at the time they sign up for services. Then, each year, we resend the privacy notice to all active clients during the month of December. The updated privacy notice provided in December becomes effective on January 1st of the following year and remains valid until the end of the year. But to ensure it's always available for viewing by any current or potential client, SyncUp goes the extra mile by posting the current privacy policy on the SyncUp Business Services website. Given what we've explained so far, you may be asking if a company you do business with can ever share your NPI with an outside company the business doesn't own and is not affiliated with. This is known as a non-affiliated third party, and the answer to that question is both yes and no. Let me explain exactly when NPI data can and cannot be shared with a non-affiliated third party. There are two approved categories for sharing NPI data. The first category for sharing NPI is automatically permitted under what is called exceptions. In this category, a financial institution is automatically permitted to share NPI with non-affiliated third parties, and the client cannot opt out of the data sharing because it is considered essential for business operations. There are three areas where an exception can be applied. The first area is when a company is processing and servicing transactions where the information is necessary to process a transaction the consumer requested, like printing checks or processing credit card payments. The second area is for service providers engaged in joint marketing options where a company shares data with a third party to perform service on behalf of the financial institution, like a mailing service or IT support. This can also be the sharing of data with other financial institutions to offer a joint marketing product, like an airline credit card offered jointly by a bank and an airline. However, there is a constraint for this type of arrangement. Here, the third party must enter a contract prohibiting them from using the information for their own separate benefit. The third area is when a company shares NPI data for legal and general specific purposes, such as when required for legal compliance, like responding to judicial process such as subpoenas, complying with federal or state laws, or reporting to credit bureaus, when operating in a fiduciary capacity where sharing data is required when acting in a fiduciary or representative capacity, when used for fraud prevention to protect against actual or potential fraud or unauthorized transactions, and finally, to control institutional risk and resolve consumer disputes. The second category permits the sharing of NPI data when the client was given the option to opt out but chose not to do it. How does a client know they can opt out? Well, if the financial institution wants to share NPI for purposes outside the automatically permitted exceptions previously discussed, and primarily for marketing purposes by a non-affiliate, they must give the client a chance to opt out by providing a reasonable way to do it, such as providing a toll-free number, a web interface, or a detachable paper form that can be mailed in. However, when the client does not opt out, then the company is free to share their NPI data for non-affiliate marketing. This includes selling or sharing lists of customer names, addresses, income data, or credit scores to third parties who want to market their own products not to the consumer, such as a bank selling a list of high net worth clients to a luxury travel agency. However, there are a few types of NPI data that are strictly prohibited from sharing, even if the client has not opted out. A financial institution cannot ever share account numbers, credit card numbers, or access codes to any non-affiliated third party for use in telemarketing, direct mail marketing, or email marketing. This data is protected regardless of opt-out status. At SyncUp, we do not share our clients' NPI with any non-affiliated third-party companies. The second part of the GLBA is the Safeguards Rule, which dictates how we protect NPI information. This rule, updated in 2021 and effective as of 2023, moves away from do what you think is reasonable to you must do specifically this. Though the FTC breaks the Safeguards Rule down into 9 specific core requirements, SyncUp is considered a small business with fewer than 5,000 customers, so we only need to meet 4 of the 9 requirements. The first requirement is the designation of a specific, qualified individual to oversee and enforce the information security program. The second requirement is the implementation of specific technical safeguards, which consists of access controls to limit who has access to customer information, encryption of customer data when the data is in transit, meaning when sending data, and when the data is at rest, meaning when the data is stored, as well as multi-factor authentication, or MFA, which is required for anyone accessing any system that contains customer information. The third requirement is the provision of security awareness training to all employees, specialized training for security personnel, and verification that security personnel maintains a current knowledge of any potential or existing threats. The fourth and final requirement is to provide oversight of service providers we do business with, because we are responsible for the security of the data even when it's with a third party. At SyncUp, we do this by selecting providers that are capable of maintaining appropriate safeguards, contractually requiring them to maintain those safeguards, and periodically assessing their risks. When thinking about the Safeguards Rule, it's critically important to keep in mind that it isn't just IT's job to keep the data safe. From the bookkeepers, to the sales department, to the content creators, even the CEO, information security is only as effective as its least vigilant staff member. That means safeguarding our clients' data is everyone's job. So, what happens if someone accesses the data without permission? An episode resulting in unauthorized access to or misuse of information stored on our system is known as a security event. And just so you understand, unauthorized access is presumed to be unauthorized acquisition of data unless we have reliable evidence otherwise. If the breach involves the unencrypted information of at least 500 consumers, companies are legally required to notify the FTC as soon as possible, and no later than 30 days after discovery. Of course, SyncUp does not currently have the 500 clients required to trigger the FTC notification process. However, we are committed to ensuring that all our clients' data is fully protected, even if a breach only affects one client. Therefore, if you suspect any unauthorized access, report it to the management team immediately so we can proactively address the situation. And last but definitely not least, to ensure complete compliance with the GLBA, companies are required to securely dispose of all customer data no later than 2 years after the data is last used to serve the customer. The only exception to that requirement is when the company has a specific legal need to retain the information. You should now understand the importance of complying with the GLBA, and that it's not just about avoiding fines. It's about protecting our clients, our reputation, and maintaining trust. Remember, when it comes to data security, store it safely, lock it, encrypt it, and if you suspect a breach, report it immediately. If you become aware of or are notified that a breach in our data security has occurred, report the incident by sending an email to tech.services@syncupbusinessservices.com. Thank you for doing your part to keep our clients' data secure.